When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shade.
Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. My name is Jeff Shade, and as always, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management. Jeff, how you doing this weekend?
I'm doing great. How are you doing?
I'm doing great, thank you. Hope everyone listening to us is having a good weekend as well, too. We're almost halfway through the year, Jeff. But anyway, let's talk about what's important to people, and that is finances. That's getting to and through retirement. I was reading a headline the other day that talked about why inflation is still upending retirement plans, even as price growth slows. And according to a survey here from Prudential Financial, they're showing that 43% of 65-year-olds say that they have postponed their retirement due to inflation, and one-third of 55-year-olds are thinking of putting off their retirement date. So with inflation the way it is coming down a little bit. Should someone really postpone their retirement, or are there ways to get around this hyperinflation?
You know, if you look at the year-to-year inflation rates, they have cooled a little bit, down in the 3 range rather than the 5, 6, 7, 8, or 9 range. Acceptable level is about a 2% range. We've averaged about 4% since the 80s. Most of that has been down around the 2%. Of course, during the 80s, there was huge inflation, and we had coming off the stagflation years of Jimmy Carter, and then it kind of slowed down. And we've been kind of used to that low interest rate environment and the low inflation rate environment. Now that there's higher interest rates, it does stand to reason that we could assume, as long as you can make, safe returns of 4 or 5 or 6%, like we are able to now, a nice range of inflation could exist kind of in the range where it is. However, the mandate is to get it down around 2. It's a lot more healthy for the economy. The other reason that, the government especially doesn't want the interest rates to remain high is because they've got to reprice the debt that's coming due. We've got tons of debt coming due every year going forward that is going to have to be repriced or refinanced at a much higher rate than what it was issued at a few years ago. So I think we do have to get things in check. As far as retiring later due to inflation, what we haven't seen is we haven't seen any of that inflation given back. Of course, I mentioned the year-to-year numbers are about 3% growth. But if we look at last year, we were going through some hyperinflation early in or late spring, early summer, where it was hitting those 9% levels from a year prior. And then they cooled off a little bit into fall, which is why the Fed says, oh, well, maybe we don't have to raise interest rates anymore. Inflation's getting into control. The actual inflation graph came down a little bit. So we're actually going off of a year ago when the inflation rates had kind of spiked. So the year over year doesn't look all that bad. But if we look at the first of this year till now, the true inflation's just in the half a year, it's up over 5%. So we do have real inflation that's exceeding, safe money interest rates in real current dollars. But if we, move the goalpost around to fit our scenario or narrative, we can find a way to say, oh, well, inflation's cooling. It's really only grown up by 2.6 or 2.8 or 2.5. The other thing that cools the inflation numbers is things like they did last time they announced the CPI, and they decided at the core, where they take the food and the gas out of it. Now they love the core CPI number more because food and gas is going up more and it isn't reflected. But then because the non-core CPI, the CPI that includes all that stuff, they had coffee going up like 78%, I think it was, and a couple of other things they decided to drop out of the equation. Well, shoot, I mean, if there's one food the majority of people consume on a daily basis, well, two, or would be, sugar and coffee, right? I don't know how you can throw one of the most consumed products on the planet for every household out there and say, oh, well, because that's up and it's going to skew the numbers and we're going to throw it out. So I think the numbers we're getting are fake, first of all. Secondly, inflation is growing at a much faster rate than we're looking at because they're not going month to month or year to date or what the cumulative rate of inflation has been since, the Fed decided not to reduce interest rates, even though they said they were going to last October. The market has priced in 7 or 8 rate decreases. We haven't had any. They keep on alluding to the fact, this rumor, oh, there's going to rate cuts, it's going to make the stock market go up. Well, so far, all those rumors of rate cuts, not only have they not happened, they certainly haven't returned any earnings or dividends or growth to the stock market. We've got, big divergence. There's only a few companies that are still growing, making money, and most companies aren't. Yet we've got this inflation situation. So back to your question about can we retire in spite of this inflation? Well, we're up about 25% inflation. So if you're going to retire, you're not looking like to buy a new house because you already do. You probably got a low interest mortgage or you have no mortgage at all. If all you're buying is really just food, gas, travel, the basics, and utilities, which are all going up. And by the way, insurance is another big one that's going up. So you got insurance going up, utilities going up, food going up, gas going up. Those are all the things that you need in retirement no matter what. Those things are up 25 or 30%. So if that's what your entire budget was going to cover, and maybe your basic lifestyle expenses without a mortgage and super expensive hobbies and travel habits, then maybe your budget was $60,000 a year to live, and that would cover everything. But now that it's up 25%, now it's $75,000. Well, you times that by 30 years of retirement, that's another $450,000, $500,000 in actual dollars spent that you have to come up with in order to live at that same lifestyle. So yeah, how many years does it take you to get enough money that will turn into $450,000, $500,000? Well, typically, if you can make a reasonable rate of return, if you have $1 million, it will become somewhere between $2 and $3 million of total income, as long as you don't risk it, lose it, and blow it up in the stock market or do something stupid with it. So, on a lot of these like index annuities with income guarantees, you can do tax efficient versions of that through the LIRPs, life insurance programs and things like that. But if, your nut to crack was $60,000 3 years ago, but now the same bills are going to cost you $75,000, well, you've got to come up with an extra $150,000 to $200,000 in savings in order to make up that difference. Oh, and not to mention, what if the inflation continues to stay higher? We get another couple of these big price increases along the way. Not just this one. We might get this one under control, maybe with a recession that is sure to come up sometime, relatively soon. There's a correction that's written all over the history wall, or the walls of history. Says that, every indication is that, all these cycles that are cycling end badly. And we're stretching the rubber band as far as we can on most of them. Everything from the yield curve inversion to manufacturing to jobs growth not being really what it is, to inflation, to stock ownership being mostly privately held to individuals, not institutions. We've got insider trading. We've got people like Jamie Dimon retiring early because they don't want to be around for the next correction. There's a lot of indications that, we're going to go through a recycle or a reset or a recession soon. I think people are kind of aware of that and thinking, if I can just keep my job a little bit longer, protect those assets. By the way, if there is a reset and if there is a good market correction, I think if you're kind of still debating on whether there will be or won't be, maybe staying at your job is a smart thing to do until you see what really happens. Because if you've still got a lot of exposure to the market because you've got 401k that's in a 60-40 stock bond plan, and you think, well, it's pretty diversified. Well, we know stocks and bonds can go down together, and we know that if there's a big market correction, it might be good that you have a job that you can stay at. If you quit now and then there's a big recession and you haven't protected your assets and you haven't turned them into income streams that you can count on or guarantee income that can replace that paycheck, if there's a recession, if there's a market correction and you've got a lot of exposure there, I doubt if you're in your 60s, you're going to go get your job back, especially at the level that you were getting paid before. Most of those companies are either terminating early people like you, or they're hiring some new person, new out of college, or somebody that they can get the same work done cheaper if they need that job filled, or they're just going to do without that job until the recession cycles through and there's a better time to get busy again. So putting off retirement, if you're kind of on that, hey, I can barely make it now, and now with inflation I'm not going to be able to live at that lifestyle, then yeah, you might have to work a little bit longer. And that's why people come in and do plans. I had a lady that she's an engineer. She told me that she was going to wanted to retire ASAP, and turned out her plan was best suited based on what she needed in today's dollars to work another 4 years. She wasn't too upset about it. She kind of thought that was the case, but it confirmed it. But at least we have a plan, and now we know it's 4 or 5 years down the road. We took profits out of 401ks and IRAs and combined some assets into an account that would generate at least enough income with about a 20% buffer over and above what she would need on a monthly basis. But working the next few years allows that plan to kind of gel and grow a little bit to give that more secure income. If she retired right now, she might be able to make it at today's dollars, but if there continues to be inflation, then she would be in trouble. So that's just one example of real world planning. Is before you retire and then decide if you have enough, why don't you decide if you have enough to retire today, and then you add a little inflation factor, some sort of a buffer in there, and say, what would it really take? How much more do I really need to save? And if it means $150,000 in savings, and you can save $50,000 a year to get there, between 401k and excess earnings that you would have otherwise been used, or by putting off Social Security another few years in order to get a higher paycheck so that you don't have to drain those assets that you save for retirement quicker. You can do it slower and with less pressure, then that would make more sense. Now, there's also those people that have such a responsible lifestyle, meaning they live so far under their means that they've saved an excessive amount for retirement. And I don't mean excessive as in a bad thing, meaning that based on their lifestyle and the fact that they have no debt and they really don't do a lot of expensive things, and they've got a few $1 million saved up and they spend $80,000 a year in retirement, I don't think that person has to work any longer. I mean, half that money would set up a retirement plan that would pay all their bills at today's rates, and you still have the other half to ride up or down in the market, or just to guarantee some slow and steady growth, in something that's principal protected, like I talk about quite a lot, or just tax shelter it in LERPs or Roth IRAs or something else by paying taxes now and just getting yourself set up for a nice, happy retirement. So, like always, the answer is it depends. Is inflation hurting some people? Yes, absolutely. The cost of retirement just went up 25% for most people, and maybe a little bit less if you're not buying a new house, or maybe you have to downsize in order to cover that, and you could retire early. But if you want to stay in place and you have the same bills today as you're going to have 5 years from now, you have to decide whether or not that money's going to still be there. And you also have to take into consideration that, we might not be back in that 2% inflation world again anytime soon. You have to have some reasonable expectations and expect that inflation might still stay around that 3 or 4% for a while. Like I said, it's averaged about 4 for the last 45, 50 years. Maybe it'll kind of hover in that place for a while. Can you make up the difference? Well, with higher interest rate environment, yeah, we can probably keep up with the inflation factor. But remember, as long as you're spending those assets down, it's harder to keep up with inflation factor because that money isn't there earning interest anymore. So again, that's why we look forward 20 or 30 years in a retirement plan. Retirement's decades, not years or months. And we need to look at the long-term picture. You just have to get a dose of reality. Unfortunately, this inflation picture hasn't been too nice to most people. Some have gotten lucky and put their money in high-risk stocks and made a little bit, and probably got back on track if they timed the market bottom and got back in if they were willing to risk. Other people said, you know what, if I don't risk, I'm in a much better place. I'd rather just, be sure and work a couple more years. Of course, that's your choice. I like taking the more sure and steady route. I sleep better at night, and most of my clients who do that also sleep better at night.
We're talking with Jeff Ogan here of Premier Retirement Planning and Wealth Management. We've been talking about inflation and how it may or may not affect your retirement journey. Again, if you'd like to get in and sit down with Jeff, talk about your retirement journey, get on a plan, we're offering this retirement roadmap at no cost and no obligation. The number to call right now to get yours is going to be 520-780-9059, 520-780-9059. I know it's the weekend, but go ahead, give that call this weekend, leave your name and telephone number. Shelley will call you back during the week and set up that appointment for you. Once again, there's no cost and there's no obligation for this complimentary retirement roadmap, just a chance for you to sit down and have a conversational analysis of what you have, or to ask your questions of Jeff to put you on a path towards a confident retirement. Once again, no time like the present to make that call, 520-780-9059. You can also find out more about us online at premret.com. That's PREMRET.com. Jeff, we were talking about inflationary figures, and 2% is what we're looking at. We don't think that we're going to get there exactly. So when it comes to inflation and you're making these retirement plans, with inflation changing as it does, what figure do you use to build into a retirement plan for inflation? And does that inflationary figure differ or change as the life of this plan progresses?
Well, it kind of depends on the person. There are some people that kind of front-end load their retirement plan with a lot of extra spending because they want to do fun things. They want to travel. They want to go golfing. They want to visit grandkids. They want to be there for every new baby's birth. They want to do stuff that they can while they're still active, young, healthy, and go-go, in the go-go year. So, sometimes the inflation factor really isn't that big of a deal. You just want a bunch of extra to spend, right? Yeah, the inflation is going to be there. The inflation does apply to Social Security at this point, so that you get an automatic raise based on cost of living adjustment, or whatever they think the CPI really is or might be as far as Social Security is concerned. May or may not be in reality according to what you're spending, but at the same time, at least it grows. Some government pensions, some private pensions do also have a cost of living adjustment. Some don't. Some have kind of a profit sharing adjustment if they feel like giving it to you. Many pensions don't have any increase. What I have found in my last 30 plus years of preparing retirement plans and watching people live through them the entire 30 or 40 years, I find that they spend less money later anyway. So the inflation factor to say, I'm going to have to need at least twice as much money 20 years from now to live as I do now isn't necessarily the case. However, if you're on a really fixed income or kind of a low, a tight budget, where the only thing you get is Social Security, a little bit of income, maybe from an IRA withdrawal or something like that, then, inflation might be a real thing if all of your expenses are only inflation related, like gas, rent, utilities, that kind of thing. Again, depending on your lifestyle or where you are right now, you may have to be a little bit more conscious of the inflation rule than maybe some others that might have a buffer. However, if you are in the go-go years, not the person that's living, kind of on a tight budget, but, want to do too many things up front, you could spend so much of it that you may not have enough to even cover those basics. And so, when we build our retirement plan spreadsheet, we show the next 30 years. I usually run them out to age 100. Some people might outlive that, but most people won't probably. And that gives us a chance to see that if you spend extra during the first 8 or 10 years of your retirement life, how does that affect your future? How does it affect, a reasonable rate of return on growth of real estate at maybe 3%, a growth of your IRAs at maybe 5%, which is really reasonable and very attainable, I think, especially if you combine it with stocks, bonds, and don't get into too much risk. Right now, we can make that on short-term fixed investments. But, if we use reasonable rate assumptions of growth, we can play around with the numbers. And I have one guy that actually redid it. One of my Raytheon engineer clients, which I have a ton of those, but, they always like to rework the spreadsheets and play some games. I had one guy turn back in his. He says, hey, what do you think of this? This is my play sheet. So he basically reconfigured it and did all kinds of scenarios. What if I spend more? What if I do this? What if I don't take money out of this account until later? And, once we built in the tax ramifications of all that, putting in the actual tax brackets that we know that are present today and are going to return after the Trump tax go away in a couple of years, we can find out kind of what the net spendable amount is. We can also find out, how it affects your future as far as net worth goes. What are the spoils going to be to split up if you die at age 90 and you spend all your money now and then you have to reverse mortgage your house later? Or maybe that's part of the plan. It may not be that you have to reverse mortgage. You want to take the equity because your kids are already well off or you don't have any kids and you might as well spend the equity in your $1 million home. Shoot, but you bought it, you paid for it, you put an investment asset there. And if you want to live or spend every last dime, you got to find a way to tap that as well, either by downsizing and take some equity off the top. Home equity lines of credit you could use. You can also do reverse mortgages where you get cash out or income out and can do whatever you want. But look at your total picture. Find out how long it will last with reasonable assumptions. Make sure that there's a buffer. Sometimes we use the home equity as that buffer so that if we get a little bit blindsided or markets don't perform quite as well as we had hoped. So, barring anything catastrophic like what the pigs countries went through. Remember Portugal, Italy, Greece, and Spain went through. I mean, they got so upside down with their GDP to debt ratio. They were in like the hundreds of percentiles that they had to actually reset the debt. I mean, anybody that owned a bond got less for that bond than it was worth. I don't think we'll ever get there. I hope America won't. I mean, we're only, I shouldn't say. We're over 100% debt compared to our GDP. I think it was 106 or something like that last chart I saw, and expected to grow to about 120% by 2030, which isn't a really good sign. That doesn't mean that we're going to default. I think we're still going to be the currency of choice. But I mean, who knows what interest rates, whether they'll be able to keep up. If there has to be some sort of a monetizing the debt situation that'll ripple through, maybe not to our bond holdings, but it might to an annuity company's bond holdings. It might also to the way that they fund Social Security and other things that they call entitlements, but I call my money that I have. I certainly am entitled to get my money back. I don't know if there's going to be some adjustments down the road. That's why I think anytime you build an income plan, you need a buffer, whether it be for inflation or any other just stupid things that happen along the way that we can't control and don't foresee. But we can also imagine that they could happen because they've happened in other parts of the world. So again, I don't think we need to go into retirement fearful. We just have to go into retirement understanding all the options and understanding that we have enough buffers built in and enough flexibility in our plan that we can weather those storms and that we also don't outlive our means. I mean, you can outlive your means in retirement too by overspending early on and not having that income stream later, or at least enough investments to support that income stream later, especially if there's some sort of a reset process in either your Medicare, your Social Security benefits, even a pension that you might have, or bond holdings, annuities, and other things. So hopefully none of that will happen. I don't expect that to happen. I believe the sun will come up every day. But I also believe that we need to hope for the best and plan for the best. We also need to plan for the worst and just make sure that there's some room to move and shake around so that we're not, out there going, man, I wish I would have, could have, should have looked at this a little bit more detailed and maybe should have been a little bit more responsible for my money early on in retirement. So I'm not in this predicament when I'm 80 or 90.
We're talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're talking about inflation, whether or not you can retire in an inflationary environment. Once again, our telephone number, 520-780-9059, 520-780-9059, if you'd like to get in and sit down and talk with Jeff. Jeff, we talked about the fact that you can retire during an inflationary period. Is there anything out there, market-wise or in the economy, that would prevent people from getting retired or preventing you from helping people retire?
Well, I think one of the biggest things that would prevent people from retiring early is if they've got everything at risk and we do go into through a big market correction or a crash. I think it's highly probable. I know the news, nobody wants to, in an election year, let us know that, manufacturing's down and employment is really going up. A lot of the job creation is really illegal aliens. And, we've got a lot of people that, just think that there's not going to be some accountability or ramifications of all this money printing that we've done over the last 15 or 20 years. But I don't see the consequences being avoidable. I don't think the Fed has really engineered a soft landing or no landing. What they've done is kick the can down the road to where it's right at the edge of the cliff. It isn't going to take too much more to kick it off that cliff. They've been propping up banks by, refinancing in a way with taxpayer money, all their bad debt so that they don't have to go out of business like those big regional banks did last year. They've given them money to invest in their own stocks. And, banks are the brokers. Bank of America, Merrill Lynch, the same company, JP Morgan, Morgan Stanley, Chase, all that stuff. They're all, everybody's the same. So, when you look, at all banks, they're the people that have my checking account and give me loans for houses. No, they also are the ones that market make. In other words, make the market. They own the stocks. They sell the stocks. They basically determine the price of stocks. And as long as the Fed keeps propping them up, they're going to continue to be able to manipulate the market. And the Fed essentially is manipulating the market kind of through the back door while they're pretending to tighten things by removing some of the money out of the market, quantitative tightening. But I don't think they've even hit $1 trillion yet. So, they're still kind of working to get things under control. So if you think that you can keep risking your money, just see what happens, because the people on the news say, don't worry, there's not going to be a recession and your money's fine and the market's going to double again in the next few years and blah, blah, blah. Well, I think you'd be a fool to retire in that scenario. I think you need to if you are going to retire right now, take the money off the table or take some of that money off the table, make sure that it creates enough income to replace your paychecks or the paycheck that you need in retirement, and then risk the rest. But yeah, I think the things that could happen in the near future that could derail your retirement is, watch your 401k become a 201k like it did in 2008 and maybe even worse than that in 2000 when you had a paycheck, but it didn't matter. Now that you're getting ready to retire, it matters. So again, those are the big things. I think that if you play it safe and you respect the market enough to not want to take losses on the money you need for income, you can set up that plan, and that's what we do. And we can show you what a reasonable rate of return and, without losing money, what guaranteed income sources you can create, how many tax savings that you can get through proper planning with Roth IRAs, life insurance products and things like that don't have tax ramifications, where you can shelter some of your income from taxes, keep more of your tax money in your own pocket and in your own community and your own family, and make better use of it. So, we can set up a plan no matter where you are. But again, my plans are going to be, how do we secure that retirement regardless of what happens in the market? But if you're not doing that, then you are subject to things that you can't control. That means somebody else is in control of your retirement. I don't like that. I mean, you need to be in control of your retirement. That's why we have Premier Retirement Planning, and we call it, our tagline is, it's your money, keep it that way. Don't let the market dictate what your money is worth or how much you can use, or Wall Street rule of thumb that says, 4% is a good rule. Really, when you could make 7 or 8% returns and be guaranteed lifetime income at almost double what Wall Street model says you should use. Wall Street's a self-serving entity. They don't care about you. They care about themselves and their money and their profits, period. Now, I use Wall Street. I use Wall Street products. I'm a RIA, registered investment advisor. We deal with Wall Street, but we also have to understand what the agenda of Wall Street is. It's a money machine, and it doesn't take individual interest into consideration. That's why you need an advisor to stand between you and the market and be an advocate for you in spite of what the market might, be able to provide or not provide for you. And also utilize those other tools and things that are available to you in retirement to make your retirement a little bit more secure. And then you don't have to worry about what might come. So I hope that answered your question. Depending on where you are, how much you've saved, and what you do with your money, what might happen in the market anytime coming soon may not be a factor at all in whether or not you can retire. It just really matters what you do with your money. However, if you just kind of wait and see, you might find yourself a year or two from now going, gosh, I wish I could have planned a little earlier and maybe secured my retirement rather than leave it to chance and find out that it didn't work out too well. And now you have to work another 6 or 8 years.
Well, Jeff, based on our conversation here today, I'm sure that our listeners may have some questions of you about whether or not they can retire in an inflationary environment. If that is you, you're not sure whether or not you can retire, you want some answers so that you can make some plans, we invite you to call Jeff and request your Premier Retirement Roadmap to get those questions answered. Again, it's not going to cost you a dime. There is no obligation whatsoever. Our telephone number, 520-780-9059, 520-780-9059. It's the weekend, but you can make that call right right now. Leave your name, your telephone number. Shelley will call you back next week and set up that appointment for you. Why go into retirement blindly or not know whether or not you can retire? You may be pleasantly surprised that you can retire right now. Again, take advantage of this opportunity to have this confidential conversation with Jeff, and certainly those questions and the answers that you have will help you form a retirement plan to put you on a path towards a confident retirement. 520-780-9059 is our number. Make that call this weekend. You can also find out more about us online at premret.com, premret.com. Jeff, we're going to take a break. When we come back, listener questions and more when Premier Retirement continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
We so much appreciate you making us part of your weekend. Of course, this is Premier Retirement with Jeff Bogan. We've had a great conversation this morning about inflation, whether or not you can retire in an inflationary environment. If you missed that or you want to hear the show again, remember, we're a podcast. Go to wherever you get your podcasts and search for Premier Retirement with Jeff Bogan. You'll find this show and many of our past shows so you can stay on top of your journey towards a confident retirement. Once again, our telephone number. Take advantage of it this weekend. Make that call to get your retirement roadmap, 520-780-9059. 520-780-9059. Leave your name and telephone number. Shelley will call you back during the week and set up that appointment for you. Once again, 520-780-9059. Make that call this weekend. Okay, Jeff, listener question time. We started off with Adam listening to us in Tucson. Adam writes, which is better, retiring at 62 and taking Social Security right away, or retiring at 62 and then waiting until 66 to collect Social Security while living on other retirement savings? So what's your answer?
You know what it is. It depends. It depends if you have enough money. I have people that say, well, I can get a bigger paycheck if I just wait to age 70, take a huge paycheck. And if you're going to spend all your savings, then that's not a good idea. The only way to really beat Social Security is take it as late as you can and live a long time and hope they don't adjust it on you. Now, why would the government adjust Social Security on you? Well, the trust fund is depleting, should be broke somewhere between 2030 and 2035. If they don't fix it, people are living longer. They keep on having cost of living adjustments. Unemployment, even though it is creeping higher, most of the jobs that are being lost are the high earnings jobs that the big companies are laying off people. We've talked about that in other shows. Most of the new jobs are government jobs. 40 to 50% are government jobs. They don't pay a whole lot. They're not high paying government jobs. So we're seeing the trust fund get exposed pretty bad. Are they going to means test that in the future when the trust fund gets empty and there's 25% deficit coming into Social Security as it needs to go out to pay everybody's bills? I just have a feeling that based on the way the government works, that they're going to probably surcharge your IRA or do something to make up the difference. Or they're going to say, hey, the people that are wealthy don't get all their Social Security because they don't need it because look at their other provisional income. Somehow they're going to probably, they may adjust it. So barring any of that, I mean, if they don't, and let's just say they don't, let's say they just hold true to their promises and somehow magically the trust fund gets fixed and keeps growing faster than what is needed to spend money on those retirees, then if you have longevity in your family, being, waiting and taking a bigger paycheck, as long as you can live 12 to 15 years longer, based on what you could have made in the investments that you spend down, you're going to have kind of a break-even point pretty far into the future, probably 20 years. If you're still prior to that 62 age and you're thinking of waiting to 62 or 66, then you're going to have probably a 15 to 20 year wait before you know if you've even made that right decision. So I never really leaned this way until recently, that you should take your Social Security early. And if you don't need it, if you're not working, take it early and invest it, grow it. You can probably, at least you got the money out if they ever do means test it or adjust it down the road or withhold some of yours, because let's say you're in better shape than the single little old lady that lives in a trailer park and can barely make ends meet. They're not going to cut her Social Security. I hope they don't. In fact, I'd be happy to give up a little bit of mine or my growth, even though I feel it's my money. I know that the government's mismanaged it, but I would also hate to see her starve at my expense just because I'm living fat. Well, maybe I should just take as much of my Social Security as I can, invest it, and be okay so that if they do cut my Social Security in the future so that they can pay for those people that are more needy than I am, then I'm okay with that. I've already got at least a chunk out, and I've also preserved those assets I would have spent in making ends meet for 4 or 5 more years. Now, some people are so hell-bent on taking a higher income that they will spend every penny of their savings in order to get this high monthly income. Well, what if something happens where you need $50 or $60 or $100,000 to fix air conditioning or put a roof back on your house when it blows off and somehow the insurance is going to cover it? Or you just want to remodel your house or buy a new car or do things. you still need some cash. So unless you're really flush with extra cash and you just want to, live on it a while. And by the way, there's reasons to live on your cash savings and not have a tax bill from the time you're 62 to the time you're 66 or at least 65 when you get on Medicare. One is, if you're buying your own health insurance and you have low income because you're living off savings that's already been taxed, you can show almost no income and get really cheap insurance off of the exchange program, right? The Obamacare. If you have to live off of 401k or IRA money and it shows as a high income, well, then you're going to have to be forking out dough for your own insurance up until Medicare age starts. And, that might be another reason to rethink retirement or what you're spending on to live or what your savings is. Maybe it'd be better to rethink that based on, even things like insurance or, what's my best course of action to be. Maybe you have, all this surprise tax money that's in mutual funds and CDs and different things. You're not using it, but you have to pay tax on the interest and dividends every year. And you just hate the tax ramifications of that. So you want to spend down some savings. Well, that's fine. One other option you could do is put in an LIRP, life insurance retirement plan, where you just stuff it full, make that be your tax-free bank, put all your taxable money or your surprise tax money into something that grows tax-free. Anytime you want money out, you don't even take the money out. You just borrow against it and it keeps growing. So, that is another option to think about, how you retire early or how you spend down your excess savings or, whether or not you want to use Social Security early or not. So again, let's look at the whole picture. There might be a more tax efficient way to play the game. Maybe you're doing the right thing the way you're thinking, maybe not. Again, that's why we look at the whole picture. We look at 30 years. We don't look at just the next 4 years and just say, what's the difference between now and 66 based on what I have? Well, that's a good place to start. But what does what I have at 66 mean if I do it this way or that way? And what does it mean to me over the long haul till I'm 90 or 100? That's probably a bigger picture to look at is what does this 4 years of taking Social Security early do for me? What does these 4 years of spending extra money out of my savings do to deplete my potential of making my money last longer than I do if I outlive what I think my life expectancy is? So those are things that maybe you haven't taken into consideration will be part of the planning process we do here. And part of the planning process, I think anybody who's looking at a multi-decade retirement ought to take into consideration.
Adam, thanks for listening to us in Tucson. And of course, if you have questions, call Jeff at 520-780-9059. Talk to him in person. Again, that number 520-780-9059. And Adam, we'll send you out Jeff's book, Retirement: The Road Ahead. Okay, Jeff, next question comes from Cheryl listening to us in Reeder Ranch. Cheryl says, would love to hear more about how to factor in plans for funding later in life healthcare costs. I took care of my parents during their last 5 years of life. The costs are so incredibly expensive and not covered by regular insurance. My financial advisor has said self-pay from savings makes much more sense for our future than long-term care insurance, and I've heard many companies are making payouts more difficult and premiums are going way up. It seems like a real wild card, and I wouldn't want to burden my children or live in a terrible Medicaid nursing home. Appreciate your perspective.
I am not really in favor of long-term care insurance that either use it or lose it unless you have really good cash flow but no assets. I like asset-based type plans. When you consider, funding long-term care, many people just use their home equity as that ace in the hole. I mean, if you've got a $400,000 or $500,000 house and you don't have a mortgage, that's $400,000 or $500,000 in assets that you're not going to be using when you're living in a nursing home, if that's the main health care you're talking about. So maybe that's when you, unless you have a spouse or somebody that still needs the house, but you could even reverse mortgage, half the value of the house and then sell it on the second person's, moving to the nursing home and still end up using, an asset-based type plan. You can also just, live under your means and know that you've got this extra money in an account that you're not spending down. That would be your long-term care bucket or your health bucket. We have LIRPs, life insurance retirement plans, that we convert a lot of assets into tax-free cash flow, which is associated with a death benefit. Essentially, you're spending the death benefit while you live instead of waiting till you die. Well, whatever's left in that death benefit that you haven't spent is still available to you prior to death. And the majority of that, it could be available to you nearly instantly for a terminal illness. If you, have a doctor say, you don't have more than 6 months to a year to live, then you can call a terminal illness rider and get those funds to use for those final expenses, or even a critical care type plan where you can get, if you did need custodial care in a nursing home or assisted living facility, and you can't do certain activities of daily living, then you could tap that asset base that you've basically set aside money for on a tax-free basis early to pay for those healthcare needs. In addition to that, you might actually get a write-off against your regular tax returns, while you're spending money as well, because you're not actually taking money out of that account as profits or as taxable revenues, you're taking it out as a loan against the future death benefit. So there's some creative ways to use what I call asset-based long-term care, asset-based healthcare planning, where if you don't use it, you keep the assets. And if you do use it, they're readily available to you. But they're also just sitting there, not costing you money as you go, or not impeding or depleting your cash flow, as you live your ideal retirement life.
Cheryl, thanks for listening to us on Rita Ranch. And, of course, we'll send you out Jeff's book, Retirement, The Road Ahead. Jeff, next question is simple. It's Ken listening to us in Oro Valley. And Ken says, because of volatility, does it make sense to divest myself of all stocks in retirement?
Well, again, it depends. If you have zero tolerance for risk, I have a lot of clients right now that are just so nervous about where the market is that they don't want any exposure at all. Most of my clients are probably that way. We still get some exposure to the stock market through indexed annuities and indexed life insurance policies that we use for LIRPs, in that when the market goes up, you make money. And if the market goes down, you don't lose. So we do have some market upside happening right now, while the market, which is, in my opinion, insane right now as far as price goes, nevertheless, it's still going up. Well, let's at least take advantage of those index returns, at least make some money on the indexes. Now, many indexed annuities and products that were purchased 5-6 years ago were based on lower interest rates and may not be getting quite the upside that some of the new ones will get. But if you're looking at rotating now from stocks into something that still gives you the upside but protects your downside from here on out, those would be a good option, because now when interest rates are higher, the companies that issue them can make a lot more money on your money. They can still protect your principal, but they can make a lot more interest for you based on market return. So if you don't want to be in the market, but you still want some upside based on the market, there are options for you to do that. Right now, there's, like I said, the stock market historically is very overvalued. Only a certain amount of stocks are going up. The breadth is horrible, meaning I saw a chart just a few days ago that roughly 450 stocks out of the S&P 500 are in an established downtrend. They are trending down. They're below their 20-day moving average. Their counterparts, the other 50 that are driving the entire index, the index is going up when only 1 out of 10 stocks are going up, which is a divergence that really hasn't happened to this magnitude ever. And the only time it was even close to this, where it is right now, was the dot bombs right before it crashed. So we're looking where the stock market is really kind of the risk reward, I don't think, is there. You're taking a lot of risk to get that upside, and you might be milking a little bit of it. Might be risking dollars to make a few extra pennies. I'd rather risk pennies to make a few extra dollars, and or risk nothing and make less dollars but never lose, especially if you're trying to get through retirement. So I don't think right now is a bad time to not have any stocks. I don't think having zero exposure for the rest of your life to the stock market is necessarily a good thing, unless you're happy with it. Some of the alternatives to CDs, we know CDs probably won't stay at 5% forever. I mean, there's a chance they could go up a little bit, because I think inflation isn't under control, and there might be a time after the election probably, but not before, I'm guessing, where they might even raise interest rates. The Fed might say, we got to raise interest rates some more and keep, we never quantitative tightened quite enough. We got to do that. Well, that might throw us into recession, then they'll have to lower them eventually. Or they might just lower them just in good faith because they've said they're going to. They might just lower them just for the heck of it before the election to make everybody happy, maybe make the market drive up a little bit. And then after the election, who cares? There's nothing to save it. So then market forces take over, and we get that correction that we've probably been waiting for and probably deserve to have. And at that point, stocks might be at a better place to buy. So I think there are times when the risk-reward ratio is smarter to have some exposure to the stock market, actually in stocks, ETFs, or mutual funds. But perhaps right now, and I think you're asking this question right now based on what you're seeing, and basically maybe what I'm saying on the radio and other people like me are saying is, be careful. This is a risky time. This is a dangerous time. It's a double-edged sword. You can make money, but you can also lose money. It goes both ways. So depending on where you're at in your retirement, and depending on how much money you could afford to lose, or you feel like you could afford to lose, or maybe your stomach doesn't allow you to want to lose a penny. If that's the case, then no, you shouldn't have stocks. Every stock has risk.
Ken, thanks for that question. Of course, we'll send you out Jeff's book, Retirement, The Road Ahead. And if you have a question you'd like us to answer on the air, you can get it to us by going to our website, premret.com, premret.com. Go to the contact page and send us your question. And again, we would love to hear from you. And of course, we'll send you out that book, Retirement, The Road Ahead. Jeff, if people want this book, Retirement, The Road Ahead, is it in hard copy? Is it in digital form? How can they get that? Do they have to send in a question to get this book?
No, they just call us. They could actually just go online and download a copy as well. They could, if they come in for a review, we'll give them a hard copy. They come and spend time with us, and sincerely, don't just line up at the door and just take all my books, because you're not going to use them. But come in if you're interested or sincere about why you're reading the book. Let's talk about it. Let's talk about the principles in the book and go over a little plan. I typically do that between first and second appointments anyway. If they don't already have the book or haven't read it, you may not have thought of all the questions you need to ask. Here, read the book. That'll bring up some questions that I think are important. And there's 10 or 12 chapters on just different topics of retirement planning that most people don't think about. Most of them think about Well, I'm 70 years old, so that means I should have 70% in safe money and 30% in stocks. Well, really? Well, who says? I mean, 30%, what if you lost half of that 30%? That's a 15% decrease. Hey, what if bonds go down because interest rates continue to go up again? We've already found that bond market can shed 20% of its value if you're not careful. A lot of people are still waiting for the bonds to come back, and they haven't. So, a 70-30 split in bonds and stocks is still underwater from 2-3 years ago. It was not a good plan. If that's all you're thinking about, well, you're going to get, caught up by, surprises every once in a while, and they're not going to be good surprises. I would rather 12 or 15 different aspects of retirement planning so that you don't have to base it on just two things, stocks and bonds. There's a lot more to look at, and we'd love to, talk to you about the book, show you the pillars and the foundation of how we build a retirement plan, read the book, and understand the questions that you really ought to be asking for yourself. I'll bring most of them up because I know what questions to ask, but, you need to know what questions to ask. You need to know that the answers are satisfied in your mind, so that knowledge that you have is powerful, and that means you can implement it with confidence and do something about it that is meaningful to your retirement.
As Jeff said, you can go to the website primrat.com and get your copy there. If you want to download it, go to the resources page there, and book is the top tab. Simply click on that, and it'll be right there. And Jeff, my favorite part of the book is in the beginning, I think it is, when you decided that you wanted to be retired, but you decided at a very early age. Can you tell that story briefly?
Yeah, well, I just used to go visit my grandparents, and they, always seemed to have enough to take us out and wine and dine us and play and do fun stuff. And after one of our trips to visit our grandparents down in Southern California, I lived in Northern California at the time. After one of these trips, my mom said, "Jeff, what do you want for dinner?" And I said, "Can't we just go out?" She goes, "Oh, it costs a lot of money to go out. We can't do all those fun things Grandma and Grandpa do." I said, "Well, why not? What do they do?" And she says, "Dad works hard, but he's a school teacher, and we barely make ends meet. We have to be tight with our money, essentially." And I said, "Well, what does Grandma and Grandpa do?" And she says, "Well, what do you mean?" I said, "For work." She says, "Oh, honey, they don't work. They're retired." So I knew that not only did I want to grow up and be retired, I thought it would be cool to help a lot of people grow up and be retired so they can spoil their grandkids and have nice things and do fun stuff and not worry so much about money.
Yeah, so you were like 10 years old when you came to that realization, which was really quite advanced. So anyway, it's in the book, Retirement, The Road Ahead. Once again, primrat.com. Go to the resources page, go to the book tab, and you'll find it right there. Once again, if you'd like to have a conversation with Jeff about your retirement journey, we are offering this retirement roadmap this weekend. No cost, no obligation for this whatsoever. Certainly there's no judgment. How do you get it? Well, you call 520-780-9059. You can do it this weekend. Go ahead and leave your name and telephone number. Shelley will call you back during the week and set up that appointment for you. Once again, 520-780-9059, or you can request it online at primrat.com, PREMRET.com. Jeff, right now we have some unusually high interest rates. I know that sometimes money markets and CDs are paying north of 5%. So I wanted to talk about some of the investment vehicles that we could get into to take advantage of while these interest rates are high.
Well, I think if you have money in the bank, it's only getting 0.5% interest in the savings. You got to get a CD, just get short-term CDs, even, 3, 6, 12-month CDs are paying, better than 4 right now. So I think your bank money ought to just continue to use bank instruments, get higher interest in the meantime. Now, I don't think interest rates on CDs are going to stay high that long, maybe through the election or maybe up until the next market crash. And, then the stock market's going to have to, reset. The government's probably going to lower interest rates. And, I think interest rates at banks are going to go down again, and people are going to be scared to do much of anything. And because there'll be so much money coming out of the market wanting to go into banks, CDs aren't going to have to pay a lot to keep money in the bank. So I think that's short-lived. If you want to lock in a high interest rate, however, based on current interest, insurance companies have not fixed index, but fixed annuities that are multi-year guarantee. They call them MYGAs, multi-year guaranteed annuity, where you can get over 6% or close to 6% guaranteed for 10 years. And the cool thing is they're tax deferred. So if it's money you don't plan to use and it's long-term money, or if it's just IRA money, and all you have to do is take a required minimum distribution out of it anyway of, 4 or 5% for the first, 6 or 8 years, then you're not even going to dip in past the interest anyway. So you can take your interest out of those during the term. You could even ladder them, buy a 5-year annuity guaranteed for, 5% or better for 6 years or 5 or 6 years. I think the best one we have is 6% at 10 years. Those are out there. And I think if you want to lock in higher rates for longer, that's one way. I think not only will it give you a reasonable rate of return, it'll also keep up with inflation. It'll also keep up with your required minimum distributions if you want safe money. And, I just don't think treasuries are going to hold out, especially short-term treasuries, which are over 5 right now. I just don't think that being sustainable. And, in a year, I just don't see that happening. The short term's been following the Fed funds rate. I think the Fed funds rate, which is over 5 right now, ought to really be tied more to at least the 2-year treasury, not the 3-month or the 1-day current rate. But, that's just my thinking. They might change that. They seem to kind of move things around to accommodate their best interests or make them look good. The Fed I'm talking about. So, I don't know what the future holds as far as, how fast interest rates will fall. But I don't believe if they do go up, they'll go up much longer or much more than they are right now. So I think locking in higher interest rates long term is not a bad thing.
Jeff, in this high interest rate environment, how are fixed index annuities judged by this? I mean, is this a good time for a fixed index annuity?
It's actually the best time that I can remember, just based on the type of leverage that the insurance companies can do with 5% on your money. If they're making 5% and you give them a portfolio, let's say you give them, $500,000 and put half of your $1 million retirement plan in something that's principal protected. If they can make 5% going forward on your money, but they can use that 5%, leverage it in indexes where they can make that 5% become 10 or 12 or 15 in a good year, but all they are at risk is that 5% for that year, you could make zero some years. But what if, 6 or 8 years out of 10, you make double digit returns and you have an average somewhere around 7 or 8 or 9 on something as safe as a CD? That's available. That is possible. That is very much potential. I mean, I've been doing reviews for the annuities we bought a year ago, and some of them are up over 20%. I've seen over 25%, almost pushing 30 in less than 2 years of growth because the interest rates have been high for a while. That growth can be locked in and become your new principal, either on an interval of your anniversary, which is of whatever strategy you pick to lock in every year, 2 years, 3 years. Or you can just say, hey, I don't trust the market. I'm going to lock in. I'm up 20%. I think that's good. So I'll just keep that 20. That's my new principal. And then on your next anniversary, you get to go into a new strategy and say, okay, how am I going to make money for the next year, the next 2 years, the next 3 years? So index annuities are the coolest thing I think that they've invented during my career. And they didn't have them when I was a stockbroker years and years ago. They came to be kind of in the late 90s as a way for safe money companies like insurance companies to try to compete, against this crazy market that was way out of control, like it is now, honestly, with the AI craze. But, back then they experimented. Some of the first 3 or 4 companies that got into it went out of business because they didn't know how to play the game or how to leverage or how to, mitigate their own losses using your interest money on options in the market. Well, they've gotten smarter over the years. They've gotten very much more creative. There's even new indexes that are not just the S&P 500 or not the NASDAQ or not the Dow that you can invest in that are a little bit more stable, a little bit more predictable, and give you higher returns on your investment than the old school fixed index annuities that most mainstream companies offer. The other thing is being independent like I am. I'm associated with a lot of other independents, and together we have billions, I think it's even over $100 billion in assets combined, where we can go out to companies and say, hey, build us an annuity or build us a competitive product that blows everything else away. And we can use indexes that most consumers have access to, but we can access them through our independent channels and proprietary products that we can provide. That's good news. The other thing is, some of our private equity offerings, private equity is private lending, basically private banking, where some private lenders for our accredited clients can participate in those things. And because interest rates are higher, they can charge more interest on their loans to the companies that, don't like working for banks and don't like going through all the hoops that they need to with banks, and can make a little bit higher interest. So those are paying more. The higher interest rate environment is better in some ways. It isn't if you're trying to buy a house or a car and you're going to borrow money. But if you're going to save and participate in the lending process, you can make a lot more. And it's a lot more likely that you'll keep up inflation in a 5 or 6% interest rate environment than if CDs and safe money and index annuities and everything else go back down to 1 or 2% returns. If inflation stays sticky around 3 or 4% on top of the already 25% that we've accumulated. So again, index annuities, great time to buy right now. I haven't seen a better time. The last 2 years has been crazy good. Some of the people that bought annuities 5 years ago are a little bit jealous if they don't have new money. And if they don't, you can at least take the penalty-free withdrawals out of the old annuities, or even some annuities have a small enough penalty to get out of that you can upgrade to a degree where, going forward, you should have a very quick break-even point, maybe even less than a year, 2 years, 3 years, but you have a 10-year contract where, 7 out of 10 years, you have higher potential. It's a good bet to maybe look at upgrading those old annuities that aren't paying so much. CDs, obviously, they mature a lot quicker. You can upgrade those as soon as, find out what the current rate is. But again, you're only locking that in for a few years or a few months or maybe a year. With the index annuity products that we use, typically you're in a contract for 10 years, but it's a product you could hold forever if you like the way that it pays and use the leverage of today's interest rates. Because when the companies get your money, they invest in a laddered bond portfolio where they lock that interest up for the duration of your contract. So 10 years down the road, you don't have to worry if interest rates are going back down to 1 or 2. That company's still making more money on your money and able to leverage it more than they would be if you just waited till interest rates went down and bought low interest rate products in the future just to try to be current with whatever the current interest rate are.
If you're listening to Jeff right now and you've got questions about investments and take advantage of high interest rate environments, well, you can give us a call right here at 520-780-9059 and ask Jeff your questions about really anything that relates to your journey towards a confident retirement. Once again, we're offering this retirement roadmap for our listeners today. No cost, no obligation for that. 520-780-9059 is the number to call. 520-780-9059. Call that right now this weekend, if you will. Shelley will call you back during the week and set that appointment for you. It's going to take you about 60 seconds to make that call to 520-780-9059 and leave your name and telephone number. You can also find out more about our firm online at premret.com, premret.com. Well, Jeff, we're out of time for this week. Thank you for your time, but most importantly, as always, every week, I want to thank our fine listeners here in the greater Tucson area for joining us. For Jeff Ogan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week with another edition of Premier Retirement right here on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.